Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, my guest is Zain Jaffer. Zain is a tech entrepreneur and real estate investor, and he got his start back in 2011 when he started Vungle. Vungle was a company that enabled video advertising on your mobile phone. He grew it rather rapidly. He scaled it, and then he sold it in 2019 for $780 million. Since then, he's gotten into real estate investing. And today, through his venture capital fund, he invests in real estate technology startups. And through a private equity fund, he invests in direct real estate. Zain, it was a really nice guy, and it was great to chat with him about his experience as an entrepreneur, his thoughts on the real estate market and capital markets in general, being a capital allocator these days himself, and his thoughts on cryptocurrency. I really took a lot out of this conversation, and I hope you enjoyed as much as I did. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Zain, welcome to the show. Thanks for being on with me.
Exciting to be on the show as well.
So let's start here. I've got a whole bunch of questions I want to ask you. I'm fascinated by your career. Let's start here. What is so great from your perspective about investing in real estate?
You know, you're asking someone whose entire net worth was trapped in a startup stock, right? I ran a startup, and what that meant, I don't know. It was madness, but my net worth was fluctuating constantly. One day you're on top of the world, the next day, you're worried about bankruptcy or whatever. And so here I am looking at my friends in the real estate sector, and they're not the smartest bunch, you know what I mean? It's like half the folks are idiots, half the folks are very smart, and that's how they take advantage, information asymmetry. And I see them, and to add insult to this injury, I'm not taking a salary and they're getting all this cash from their rentals. And they're leveraging up. I don't know how, with like $20,000, they're buying $100,000 properties, and then they're flipping. They're making stupid moves, lots of risk and mistakes, and yet the houses keep appreciating. And then they can 1031. I'm like, this is the best sort of financial instrument I've ever, I can't even imagine. And you can get really good 2-3x returns in a safe way. It's like the best of all assets. So I thought, okay, when I sell my company, I really want to experience that, and I want to have real estate be a big part of my net worth and portfolio. And that's what I did after selling the company. I been buying real estate. Now I do it through a private equity fund that I'm part of. And it's the world's best asset in my view.
We run into a lot of smaller business owners that go through a similar experience, but it's more from like hey, there's a listing across the street. I can go there and see it and touch it. This stock and bond stuff you're talking about, I don't really get it, and I can't. I can touch that, and I can remodel it, and I can flip it. And the 1031 feature is just the tops. I mean, that is a really nifty maneuver. That's not that commonplace across other financial instruments, of course. So you got interested in this after selling your startup company, and now you're pursuing other subsequent real estate investments through your private equity fund. Tell us the difference between what it's like doing it through a fund and what it's like doing it for yourself.
On the real estate investment side, or you mean being a startup founder versus being a real estate investor?
On the real estate investment side first.
Oh, man, I was so eager to get going. I was doing hard money loans. I was buying single family rentals. I was listening to all these podcasts and figuring out, okay, multifamily is where it's at. That's where the scale is. So let me now buy, multifamily buildings. And I ended up buying 400 buildings across Texas. And oh my God, firstly, here I was with a pot of money, and I didn't really like the idea of giving it to other funds to manage for me and basically to sponsors. I'd look at the deal terms and I'd be like, why am I paying a management fee? Why am I paying an acquisition fee? why am I giving so much of the upside away in terms of a promote? And boy, I wish I'd done that all day long, right? A larger platform has relationships. They've got the financial track record. Here I was, and I had to prove to banks, like, you can lend me money when, I have no real experience. And as soon as you dial from your California zip code to a place like Texas, those brokers love it. Suddenly the price is jacked up. So yeah, doing it myself was a bit of a headache. You're now dealing and making decisions, and you've got to make decisions quickly on every aspect. Everyone's relying on you to decide what type of roof do you want? Which vendor shall we go with? Here's 5 bids. I don't know the faintest clue about plumbing and roofing and electrical work. But I know a lot about technology, so I thought, okay, this is a lot more involved than I expected. But I learned a lot. Really learned so much through that, and made mistakes and learned from those mistakes. And then I realized, wait, I could get a lot more scale if I just team up with the private equity fund, which is where I decided to ultimately focus. And at Bluefield Capital, they've got billions of dollars worth of real estate. We're talking multiple asset classes, so it's a lot of fun because I wanted to learn. It wasn't just about money for me; it was about learning. So partnering with these folks, seeing their extensive Rolodex of every type of connection possible, right? Best property management firms, best construction developers and GCs and lenders and brokers and direct relationships with sellers. It's like, wow, across multiple asset classes too. So Bluefield has a lot of multifamily, but also quite a bit of hospitality assets and senior care facilities and industrial warehouses too, and doing a lot of construction and build to rent across the entire US. So what a big playground, to sort of learn from, and that's the difference. And so ultimately, what worked out better for me, believe it or not, being an LP worked out better for me than being, hands-on operator myself, because the game is rigged. I feel the game is rigged against the larger platforms. Brokers do business with larger platforms constantly. Lenders are much better to give better rates. Property management firms are better to sort of cut you a break. There's processes. They know exactly how to manage insurance. They know how to manage every little element, right? And bring in best class processes. So when I got my K1s, I didn't understand. I'm like, I own this asset 100%. Yet these these GPs, these sponsors who I'm investing in, who are taking all these fees, are actually making me more than I'm making myself. Wow. And that's the big lesson. That sometimes it pays to team up with someone experienced. Don't get too hung up on owning 100% of something that could be very little versus having 70% of something that could be really huge.
Right, right. Especially in that space. It seems like doors start to open when you hit critical mass, and just having all those pre-existing relationships to learn from must be a great place to sit. Now, where geographically are we talking within Bluefield's portfolio? Is this all over the world, just in the U.S.?
Well, it's all over the US, a lot of focus on the Mountain West type of states. Your Montana, your Utah, Colorado, Arizona, Wyoming, all these types of areas, Sunbelt areas too. But then, there's a couple of things on the East Coast, a couple of things on the West Coast. But primarily Mountain West is, I think, where the strength is. And we're pretty good at identifying what I would say would be secondary, tertiary markets, areas where there's a lot of mom and pop activity, but there aren't that many institutions yet. So the secret's, not out yet. And so you're there and you're able to operate at this 10 to $50 million acquisition range. And that's sort of a little bit too small for large private equity firms and way too big for smaller folks. And so, you're operating in this area where there isn't as much competition. But, I'm talking very, city or metro specific. I'm not talking about like, all of Texas. It could be a few regions in Texas, a few regions in, Colorado, Arizona, or New Mexico or whatever.
Sure. Sure. And that's something I've noticed over the last 10 or 15 years is the institutional money coming into single family homes has just skyrocketed, right? Am
Yeah.
I encapsulating that correctly? I mean, there's huge institutional investment in real estate these days. So when you're looking for potential opportunities, what kind of stuff are you looking at when you're evaluating whether it's a good fit or not? Probably more than just cap rate, right?
You know why I laugh? Because all of last year, we made 100 straight offers. We're talking billions of dollars worth of offers, and we barely acquired much. We maybe acquired 3 or 4 assets. heartbroken by that because I felt like there was a window where it was a buying opportunity of a lifetime, and everyone caught on. Here we were like, okay, let's get creative. Let's maybe buy this hotel and turn it into multifamily. Nope, everyone's doing that already, right? Hotel conversions to multifamily. And so we had to work really hard to find places. But, frankly, there was so much dry powder, and we were shocked at how aggressive people were just to, you know, win deals. It becomes emotional when you start losing deals and you're like, yes, we won this deal. Oh no, we don't want to lose this deal. You get emotionally tied up in that. And when I sat down with one of the groups that won a deal that we lost on, we were like number 7. They were like number 1, right?
Yeah.
How did this deal pencil out for you guys? I don't understand. We looked at the market, we looked at the comparables, we looked at the rent growth. They were like, well, we had to make some assumptions. My alarm bells start ringing. Well, what type of assumptions? Well, we had to make the model. We penciled out on the model. Really, what that means is they assumed cap rates are going to continue to compress. They assume the Fed's going to keep printing money and interest rates are going to remain low forever. And they assume that these insane rent growth, will continue. Yeah, rent growth actually is continuing, but any one of those other levers can kill your plan. And, there also came to a situation where so much dry powder sitting on the sidelines. Well, large firms can come in and are happy with a 3-4% cash on cash. We can't do that. We're value add investors. We at Bluefield has generated since 2013 a net IRR of 33% to investors. So when we underwrite a deal, we want to see really high teens. We couldn't get there on anything. And, we started out with we do deals in the high teens net to our investors. Then it turns into, okay, this is our 50th deal we've lost now. I guess, the market's changing. We're now okay with sort of low teens. And then you're like, oh, do we go down to the level we're doing single teen returns? And, we didn't. And now it's a buying opportunity, finally. Mortgage rates are increasing. We've got dry powder, and now we're starting to see we're winning offers. Valuations are coming down. And I think this is the buying opportunity, and patience is paying off,
Right. So valuations are already starting to come down. I have to think that that's directly related to interest rates, borrowing costs, and probably not a whole lot of other widespread economic effects beyond that, right?
Right. I mean, there's lots and lots of factors, each one depending on the asset class or the, geography you're in. But don't forget, too, I'm an example of this. I made quite a bit of money in tech. I put a lot of my money into stocks and bonds and liquid securities, get insane interest rates, like, sub 1%, right? You borrow against that and you put money into real estate. Now, what happens when the markets start to crash like they are now? Liquidity dries up. You can't suddenly write these big checks because, you don't want to be over collateralized and face margin calls. So there is a lot of that happening. A lot of folks I know in the tech industry are doing the same thing. I'm putting myself out there as someone that did this too. We like risk, tech people, right? But that's also hurting people too. And overall, if you look at, and I think you coming from the, sort of the investment side, the RIA type of approach, LPs and fund managers right now are getting tired. Suddenly when every asset class is acting weirdly, hedge funds are not performing well. For years and years, there've been really poor returns when the market was in a bull market. Now hedge funds are, not doing great. I've got hedge fund exposure, which is disappointing. Bonds are acting really weird. Crypto is not the inflation hedge we thought it would be. It's down. Stocks are down. Everything is going down. And so when you're allocating your investments, you're like, oh my God, well, let's take a breather for a second. What's going on? Then private equity is making a bunch of capital calls. And so, yeah, I think that's also another reason. It's institutional and sort of the end LP is getting a bit tired and sort of confused about, well, how the hell do we allocate? How do we get, risk-free or risk-adjusted returns here,
Right. Yeah, on the one hand, it seems relatively basic and simple. We have interest rates going up. We've had almost unlimited liquidity in the system for a long time. Now we're going to start reducing the size of the Fed's balance sheet and start reining a little bit of that capital in. So, of course, risk assets are going to come back to earth. Then again, we have some odd behavior within each of these risk assets, as you pointed out earlier, which is making a lot of people's head spin. You got to have the right plan in the first place, I would say, for which is something we spend a lot of time on in our shop.
And I think also it's sort of this chicken little game going on right now where the Fed propped up the entire, markets. And it felt like, these memes were floating around the internet where, Jerome Powell and sort of the Fed the money printing machine just keeps going and going.
Yep.
This is a free put option, or on the market. And now the Fed is being quite hawkish. Now the Fed is increasing interest rates by 0.5%, and they're going to continue to increase. And the street's confused. Like, wait, the Fed's actually going to now, do this?
Yeah.
They've gone from one extreme to another, and that's sort of panic as well.
Right. It's easy to forget. They have a dual mandate, right? Two things. That's it. Price stability first and foremost, full employment after that, but not at the expense of the first. And we just haven't seen the inflation numbers over the years up until the last, 18 months to justify any other move. And it's easy to forget, what history actually looks like more than 20 years ago, because they've driven the economy into recession more than once because they had to capture the price stability. So here's another question for you, semi-unrelated. We have all this institutional activity in the real estate market. Some would say, if you're someone who is trying to buy your first house, that all that interest in residential real estate at the institutional level is driving up bids and prices and making it harder for new people to buy their first house. What are your thoughts on that dynamic there?
The SFR asset class is certainly becoming institutionalized. You're no longer just competing with another emotional buyer. You're competing with a new range of buyers, folks that are cash flow focused, folks that are even iBuying, although that hasn't worked out terribly well. But look at what iBuyers were doing. They were paying through the roof without even visiting properties, sight unseen, they'd make offers, right? So I think that's a lot of pressure there. I think that pressure's sort of dying down a little bit. I think, if the advice is to someone that wants to buy a home, you've got to get on the property ladder. The game is rigged against you. This is how capitalism works. You want to live that American dream, you need to own real estate. You need to, own your home. I appreciate that. It might not be your own home, but, you want to own real estate. Someplace it makes sense to rent, someplace it makes sense to buy. Institutions will do what they always do. But I think, if you love the place and you're going to live there for the long term, it makes a lot of sense to buy, and you have to be agnostic. You can't look at you can't look at it from an investment perspective. So let me sort of explain what I mean. Okay, I was buying a bunch of single family rentals in San Francisco, and condos, single family rentals, and I kept trying to find that real estate that would appreciate but also be good for cash flow. I couldn't do it. Either something was a complete appreciation play and it's a place you want to live in and you love, or it was like a horrendous area, but it was amazing for cash flow. And I kept trying to find real estate deals and ended up with mediocre deals. And what I'm trying to say there is, if you're a buyer and you want to live in a home, it's an emotional purchase and you've got to think about location and appreciation. It's a very different perspective. And then I decided, okay, you know what? The home I buy, I'm not going to try to analyze it from downside protection. Like when I bought the home I live in now, I was thinking to myself, okay, you know what? I want to buy a home that's going to appreciate, but I also want it to be a really good investment. And I realized that doesn't exist. At least to me, it doesn't exist. And you can't put it on an Airbnb. So that's one thing, you can't do easily in California. So I bought a home I love. I probably paid way more than I wanted to pay versus, what I would have paid for a cash flow property, because I couldn't rent this out and get anywhere near the yield I would, right? But then I also bought a bunch of things I would never want to live in, but they generate good yield for me. So, it's different. How institutions look at things and how consumers look at things, very different.
Yeah, it should be. It's a good point. It's two different logical decision paths completely. Your home is your home. We tell people that all the time too. Don't think of it as an investment, because you're gonna get yourself in trouble somehow. Yeah. There's a lot of ways to go wrong there.
Right. So, and people think, and I thought too, I could live here for a couple of years and then, I could sell it, I could rent it out. I think that's a fallacy, really. I mean, firstly, sell it in a few years? Are you kidding me? Like, look at those transaction costs. I mean, that's going to kill your returns immediately.
Yeah.
So buy a place you're going to live in forever, or buy a place that you don't really like, but it's an investment property and you're okay living there for a little bit.
Right.
Make a choice and take a stance.
Yeah, yeah,
Yeah.
right. And we were talking about 1031 exchanges earlier too. We also have the nifty personal residence exemption that works pretty nice too. If you're going to if you're going to buy a place and live in it temporarily, then move away and you're not sure whether you want to rent it or live in it, as long as you've lived in it for 2 out of any of the last 5 years, you get a $250,000 tax free, a $500,000 if you're married. So you can still move out of it, rent it for a little while, and then make your
Yeah.
decision, kick the can down the road. As long as you sell it within 3 years of moving away, you still get $500,000 tax free. Pretty
Yeah,
nice.
and you also get pretty good mortgage deals too if it's your primary home and your primary residence, right? You're not going to
Exactly.
get an investment property. So, the prudent thing is if someone wants to, my advice would be if you're early in your career and you want to really invest and make a move, buy an investment property, but live in there initially. Live in there initially, get a primary mortgage. If you're really creative, you could get a duplex, a triplex, or a quadplex, right? And then do the smart thing. Live in there for a year and then rent it out,
Yeah.
or rent 3 of the units out. And, always try to live below your means. I mean, that's wisdom that I think will carry forwards, forever.
Yeah. Yeah.
Yeah.
Absolutely. I mean, it's just foundational personal finance stuff. If you spend less than you earn, you're probably going to be in okay shape. It's hard to go down a wrong path there. So you have joined the private equity firm. They have all these great resources. They're at critical mass to where they have scale and the ability to get preferable terms on the deals that they're doing. I sense that this experience for you, I mean, has been incredibly educational. But are you building towards something, learning as much as you can to do something else afterward? How do you see your career unfolding from here?
Wow, you're gonna make me reveal secrets on the show, I guess. Look,
We don't have that
I
many people listening to it, so it's not going to get out of the bag.
so look, I've always been a founder at heart. Always, running companies, building things since I was a teenager. And I entered the real estate industry because I ultimately want to run a company, want to do it in my next startup. And I felt the best way to understand the real estate sector is to start buying real estate, understand it from the investment perspective. Then the next step after that was, okay, now let me start investing in startups to get even closer to where the action is. And all of that is culminating into drum roll, guess what? Gonna launch my next company eventually, right? And that's the path I'm on. I think we'll launch a company in the sector, but now I have a platform. I've got relationships, I've got first-hand experience owning real estate on the investment side. I've invested in PropTech startups. I understand the dynamics now of building technology that sells to the real estate sector. That was the plan. In theory, that's how the dots connect. Otherwise, it looks like a random journey.
Yeah.
Yeah.
So tell us about PropTech. So this is your investments in start real estate focused startups is through your family office or venture capital fund. How is that set up?
Mainly through the Bluefield Venture Capital Fund. Bluefield has many funds. It's a good sized institutional player. We have a lot of real estate funds, but we also have a VC fund that I set up as a way to get exposure to startups. And we've invested in 20 or so prop tech startups. And what prop tech really means is any technology startup that sells to the real estate sector. It could be divided into, asset class. So you've got startups that target the hotel sector, the multifamily sector, or you could do it by the job role and function. So the job role might be I'm an asset manager, I'm a property manager, I'm a GP or a fundraiser, right? Or a bank or a broker. Or it could be a little bit more granular and you look at the workflow, sourcing deals, renting apartments, contacting tenants or whatever it might be. That's how prop tech can be thought of if it helps in one of those areas.
Sure. So no specific focus within any of those areas. You're finding good ideas, good founders. How are you sourcing your opportunities there?
So we started out by looking for startups that would complement our portfolio because ultimately, if we own a lot of real estate, we would love to bring in technology, get away from good old spreadsheets, implement IoT devices like smart locks and AI powered security cameras and 3D virtual tours, all these things that can cut costs and improve your ROI. But then we also started thinking, where are the bigger trends? This industry is about to go through some serious disruption and is going to eventually adopt a lot of technology. Who will the winners be? So yeah, that's how we have been thinking about our investments. The deals just keep on coming to us. I run a podcast, as I alluded to earlier, PropTechVC.com, and we have tens of thousands of people on that. I have a newsletter that goes out to 15,000 people. Every time I send one of those newsletters out, I get hundreds of people. Hey, I got an intro to a startup incoming, and I'm like, oh my god, I'm scared to send out a newsletter. Really, I am. Like, I haven't sent one out for a couple of months because I'm still dealing with all the deal flow that came from the last one. So there's a lot of startups out there, and the deal flow is pretty good. I think when you have a good platform, because you're a strategic investor, right?
Right.
I'm not just a venture capitalist. I'm someone who, we at Bluefield, we own real estate. We understand the asset class. We're going to add a lot more value than just dumb money.
Right. So what kind of you have introductions coming in from all angles to startup founders. How are you picking through them? What are you really looking for? I mean, aside from complementary strategic positioning alongside the real estate portfolio, what's are you seeing any really attractive ideas or themes?
I see the same idea way too many times. The same old, which tells you something's wrong here. It's not being addressed, or be careful. It sounds good in theory, but it isn't working for some reason.
Yeah, right.
There's 20, 30 people doing this. So it's actually hard to see very unique ideas, but I think every startup we've invested in is doing something unique. Mm-hmm. Frankly, if the market size is huge, and it usually is, right, in real estate, you have to be specific. Like, okay, what is the actual market you're targeting? Like, why don't you name me like a section of real estate that comes to your mind, for example?
Section of real estate. How about transactional? How about title companies? That's something that could be run through the blockchain, right?
Oh my God, let's not talk about blockchain now, but yes, let's just take the title company example, right? Well, now you're looking at what is the market, size of that. And then you segment the title company industry further and you think, okay, there's a lot of smaller folks, there's a lot of bigger folks. The technology that the big folks want and the technology that the small folks want can be extremely different. So any vertical you take, you start to drill down and then you realize, okay, if you're dealing with the large ones, you've got this issue where there's like a distribution issue. The big title companies have tremendous distribution, but how you get to them to reach scale? And the sales cycles take forever.
Yeah.
And then if you go downstream and you look at sort of the mom and pop title companies, right? Much easier to get, but the pricing point is going to be a lot lower, and their needs might be radically different from the needs of someone that's larger and more professional. So then you really start to look. Actually, this market size doesn't look as big as I thought. This $300 trillion asset class suddenly is. I've seen startups where it's like, this is only a $20 million a year revenue opportunity if they address the market.
Yeah.
I'm not going to get my return as a VC. I can only get my return if I can see a path to a minimum 10x. I want 100x when I invest in a company. So when you really dive into the target market you're going after, that's when you see, now that's interesting. You talk about title companies and blockchain, for example, right? I've invested in Fabrica.land, which is really smart. They're allowing land to be sold through an NFT. The underlying land is owned by a trust, and the NFT is a beneficiary to that trust. And you can list that on OpenSea, and you can buy land as easy as a click, right? That dream of, one click own the land, not have to wait for all of this nonsense that you go through when you deal with title companies, can I say, really smart. And then I've seen other companies that are, consolidating. They're buying smaller title companies, bringing in technology, and, they get tech multiples. They buy traditional businesses at a low multiple and have a tech multiple. So yeah, some market sizes can be very attractive. But yeah, so look, coming back to your question, what do I look for? A huge market size. As a VC, I need to make 100x return, at least at the level I invested, right? Can I dive into that? Okay.
Sure.
There's a company I'm investing in at a $10 million valuation. What do I need to make 100x return? Is it 100 million? No, that's a 10x. Is it a billion? On paper, it looks like 100x return. It's not. It's not a 100x return. I actually need a $3 billion, exit there to make that. Why? Because I'll put the first money in, but more money comes on top of me later.
Oh, sure.
And if more money comes, I get diluted. I like to assume I'm going to be diluted by 2/3. I have to assume, it can be half, but I like to assume I'll get diluted by 2/3. So I'm now looking at this and I'm thinking, okay, I'm investing at a $10 million valuation, but I need this business to be worth $3 billion to get my 100x. Then you look at the market size and you think, this is never going to happen. If the maximum revenue this company can capture, if things go perfectly, is 100 million a year, I don't see it. And yeah, you could take a 100x forward revenue multiple like the industry has recently, but look what happens. Multiples get compressed. Public stocks are getting crushed and hammered. So market size is probably the most important thing for me. And then it's also, is this an amazing team? And that's subjective. We have our biases, but repeat founders or people that come from the industry have already achieved a lot. That's what I look for when I invest in companies.
Sure. An interesting thing has gone on, slightly off topic, in fintech recently. So my financial planning firm is a registered investment advisory firm, RIA firm, and a lot of financial planners who have been chopping wood in the industry for a while have just uncovered huge needs that are ubiquitous to all advisors. It could be trade rebalancing software or sales or marketing. There are a number of friends of mine, financial planners, who've started fintech companies to serve financial advisors. But there are not that many of us around the country. There's probably 300,000 to 500,000 registered financial advisors across the U.S. It's not a large enough market for most of the VC and private equity money to be that interested. So it's been a nice opportunity for investors who have a little bit of extra cash to pony up and access, because that institutional money is not interested in it based on the market size. And so for everyday investors, it seems like when you start to evaluate opportunities for private or alternative investments, the stuff that the institutional money can't access is, might be a little bit of a sweet spot in terms of your own personal ROI. I mean, I don't have enough cash to dilute the IRR on something like that. I guess is what I'm trying to say.
Yeah, some businesses shouldn't raise VC funding. Some businesses are better off being lifestyle businesses because the TAM isn't there, but there's a good return, a good 3x, 5x, 10x, but it's not going to give you that big outsized return. And if you take venture funding for a company that isn't really built to do that, it doesn't operate in a market that favors that, you're going to butt heads with your investors later on. There's going to be, a lot of conflict that will come out. Incentives are not aligned.
Right.
People glamorize raising venture funding. It sounds glamorous because, it sounds great. Like, oh, wow, VC's back this. It's going to be the next Uber. Yeah, right. For everyone Uber, and Uber didn't end well either in some ways, right? There's thousands and thousands of companies that fail. And VC isn't the right route for many companies. It's better to bootstrap or just take a bit of angel money and be done.
Yeah, absolutely. So looking back on your career at this point, you're focused on the real estate space right now. Your startup that you started, grew, and then sold, was that in 2019? Did I get that year right?
I got the cash in 2019.
You got the cash in 2019. And the name of the company was Vungle, and was it mobile advertising monetization?
Yeah,
focus?
Exactly. Yeah. Showing video ads on gaming apps.
Got it.
Nice. And we built a huge company out of a very tiny niche.
Very cool. So looking back on the whole experience, I mean, you've had a couple of years to reflect on it. What are your thoughts on the whole shebang? I mean, what was the timeline like, launch to getting cash out of it? You mentioned that your whole net worth was locked up in the startup at the beginning of our episode. Tell us a little bit about the journey.
And it was numerous journeys, right? Many ideas, many companies, many pivots, some not so great outcomes, and then boom, you hit an idea and it takes off and it's a rocket ship. We launched in 2011, and I'll explain. In the first year, we did $850,000 in revenue. Not bad for a first year. Second year, we did 15 million. By the third year, 56 million. Right? Till ultimately we were doing hundreds of millions and had hundreds of millions in the bank, all from, EBITDA. I ran a company during hard times. Gaming and advertising were out of favor. Our board wanted us to sell many times, and I was against it. But as it became apparent, no one wants to buy this thing because the markets were sort of not very favorable to the type of company we operated, right? we had to focus on profitability, and that gave us control over our destiny. Now, we sold a few months ago. I felt like it was the biggest mistake of our lives because one of our competitors went public at a $40 billion valuation. And we were the same size once upon a time ago, and we sold for 780 million. Now, with stocks collapsing, I feel like, oh, it was a genius move. We timed the market, right?
Yeah.
No, I mean, the company would have been worth more for sure, and probably is worth, multiple billions at least, right? But, it was a good return. Yeah, look, it was a wild ride. It took 8 years of grinding before I had this cash. And when the cash came, my God, it came in one lump sum, And it was like, what the hell do I do with this cash? My real estate, obviously.
Buy real estate. Was your intention always to build it up for sale? Did you have any idea what that part of the vision looked like when you launched?
When I tried, a few times when you try to build a company for sale, you're going to build a rubbish company. You're going to focus too much on what the roadmaps of the acquirers look like. You're going to focus too much on marketing and trying to position the company for sale. Instead, forget them. Build company for greatness. And if you build a company that can go public, you can always run a dual track process, but you're creating value for customers. You've got a foundationally strong company. That's going to have value to someone, right? But build it for the long run. And what I'm aching to do next isn't, oh, I'm the guy that built a company and then in 5 years sells it for hundreds of millions. No, I want to build the next company, and I say this at this time at least. But, run it forever, like run it for 10, 20, 30 years and build a great company. What shocked me was when I mentioned the revenue growth, right? Year one, 850, year two, 15 million, year three, 56 million, until we've got hundreds of millions in revenue. Did you notice every single year we were doing more revenue than the entire life cycle of the business? That's what happens. It's like the game gets good when you grow. It's like, okay, all this hard work is paying off now. Yeah, there's a whole new set of things that keep you up at night. But every year I stay in, I'm building a platform. I'm building moats. I'm building a sales force. I'm opening offices around the world. We're doing more revenue this year than we did in the entire history as a company. That's what happens when you hang in there long enough.
Yeah.
Eventually, you get to this crazy scale, right? And very few people think of it in terms of, this is something I'll do for 10 or 20 years. And most people can't because, their money's tied up on paper and it kills you. I guess the luxury of having an exit now is I don't need to take money out next time. I can hold on to this thing and my real estate portfolio should generate my income in cash. But the startup I do, ride that thing, to the moon or to the stars or whatever. Yeah, 9 out of 10 likelihood it will fail completely, but get back on the horse and go again and go for the long haul, not a quick exit.
Yeah. It's interesting to hear you put it that way. At the end of the day, it all revolves around your customer's experience and adding value to someone or something. That has to be at the nexus of it. And we see this across all industries, people we talk to on the podcast and the financial planning firm, all of it. If you get focused on the wrong stuff and the output of the whole thing, you're already off track. It has to center on customer experience and adding value. The other good stuff will happen if you can get that part right.
Yeah, that's the case with everything in life. If you try to take shortcuts, you're not building from the strong foundations, especially in real estate. If you're trying to put lipstick on a pig, refi, get the hell out, or, quickly flip it. It's a house of cards and eventually it will catch up on you. You'll be caught and it will hurt.
Yeah, that's right. That's right. So did you make any mistakes along the way? What was the hardest part?
Hardest part was shifting from being a founder to a capital allocator. And particularly in the context of real estate, when you're wearing the hat of a technology investor or a technology operator, you're focusing on the vision, you're focusing on the charisma of the founder you're backing. And basically, you want to buy their pitch. Do not do that in real estate, my God. Do not buy the pitch of the broker or the seller, right? You've got to, I have to say, I feel like in every industry there's bad actors, but my God, the amount of bad actors I've encountered in the real estate sector, a lot of dishonesty, a lot of things that you need to validate. The other thing is, in startups, you rip up the financials. Like, I don't care what year 5 forecast looks like. It's hard enough to know what your revenues will be in 2 years. This is just an idea, for God's sakes. So I'm not looking at the financial plan. What I am looking at is, okay, what can you do in the next 12 months? And how are we going to manage burn so you don't run out of money? But we're shooting for a big exit here and a big outcome, or outcome rather than exit, right? So you rip up financials. So you get kind of lazy when you look at real estate. You're like, okay, now you have to scrutinize the rent roll, and that was a challenge for me because I just forever, I was operating as a technology operator, and then operating as a real estate investor required me to switch hats. And suddenly, you're very skeptical about all the vision that the broker says, and the pro forma they're giving you is a pro forma. It's not actuals, and it's like, well, okay, this is assuming everything goes perfectly.
Mm-hmm.
So I'm buying the ARV.
Right.
No, I don't want to do that. I want to make some. It needs to be juice for me to squeeze.
Yeah.
So that was yeah.
That is definitely a change in mindset. I'd be remiss if I didn't ask you whether you own Bitcoin and other cryptocurrencies and what your thoughts are on trajectory from here.
I can't opine, and I don't track it anymore and like day trade it or anything. I have cryptocurrencies. I try to catch the falling knife, which means buying the dip and then ouch, it keeps dropping. It's okay. I think crypto is an important part of portfolio diversification. I don't think those 100x returns are possible anymore. But I think the promise of Bitcoin and the promise of crypto hasn't delivered. It's not the inflation hedge I wanted. It's not the uncorrelated, asset class. But hey, it's cool to own. You just don't know what's going to happen, and it's in that high, that it's just part of portfolio diversification. At some point, Bitcoin might reach 100K. Great. It might go to zero. I don't think it'll go to zero, but it might drop significantly. I mean, the volatility of Bitcoin is stomach churning.
Yeah. Yeah. I mean, from my perspective as a little bit of a layman in crypto, I'm somewhat well versed, I guess. It's just we're in the infancy of the potential applications for this whole thing, and Bitcoin is always going to be your entry level cryptocurrency and the mode of exchange to other cryptocurrencies along the way, right? And so whether it's Ethereum is the vehicle that is driving us towards smart contracts and all the other cool applications that a lot better than me, a lot of it's going to run through Bitcoin anyway, and it's a world changing thing. Applying the concept of blockchain across industry, and we're in like the top of the first inning there. We're just starting to scratch the surface.
You're talking to someone here who built, built a great company, right? We employed a lot of people. We changed a lot of lives. And when I was starting out, I was pitching the idea, hey, we're going to show video ads on a mobile phone, but not just on a mobile phone, on gaming apps. Folks are like, wait, what? Wait, what do you mean apps? Like, no one's going to use apps. And when they tell me about apps, they're like, wait, you mean the farting apps and the flashlight apps? You're seriously pitching me a business to deliver video ads on farting apps. I'm like, no, we're in the early innings. This is the infancy. They're like, okay, well, the video would crash the phone because the bandwidth just isn't there. The infrastructure isn't there. That's what I was dealing with. But I plowed ahead and I did it. Blockchain is in the same stage right now. And I would say more relevant to the real estate industry, security tokenization, the ability to tokenize real estate assets. That's really in its infancy right now, but it's going to be the most disruptive trend. And it's going to completely rip apart every area of real estate and every job function in real estate. Title companies are going to get disrupted. RIAs are going to get disrupted. Fund managers, sponsors, brokers, all these roles, right? They're going to be disrupted because if people can instantly trade in and out of a real estate, token, like the count of a stock, you don't have to go through this arduous process of dealing with all these middlemen that take all these fees. And, a lot of them, sometimes I'm banging my head, like, why is this title company screwing this process up? This damn attorney needs to pick up the phone and call the other attorney and get that paper signed.
Yep.
And it's just like, this is so manual. It's ridiculous.
Yeah.
20 years from now, this won't be the case. And I hope 5 years from now it's changed. But, it's not going to remain this way. Real estate will be liquid like stocks are, for sure.
Right. Yeah, that will be a huge change. I struggle to envision even what the world is like in that environment where we can buy and sell any property at the drop of a hat. through a smart contract. If X, Y, and Z are true, then close, money goes, you got the property. That's crazy. So Zain, I really appreciate you taking the time out of your week to join me. Where can people find you? Where should we drive people?
PropTechVC.com. You can reach me on Zain at PropTechVC.com, and that goes straight to me. I may take a while to respond. That's also my newsletter email address. So I get, I tend to be a little bit slow at times. Please forgive me. But mention you heard me on the show, and I'll try my best to respond.
And try to temper your introductions to startup founders because Zain's filtering through quite a few of them.
No, I mean, I find myself sometimes working as hard as I was when I was a startup founder. Running a VC firm is like running a startup, and it can be exhausting having 10, 12 meetings a day with founders. And then you end up, in a situation where you're like, okay, I've got to manage my pipeline. It's like a real estate project, Like, okay, some projects are in the DD stage now. I need to stop everything. I need to focus on this deal and analyze it, do reference checks, write a deal memo. And, the more deals you do, the more of a portfolio you have, the more founders want to chat to you and get your help. And that's my number one duty, is to help the founders and, we've already invested in. So, it's a process to manage. And me, I've tried to keep it very lean. And we don't have any staff. It's just me and, another two partners. And we refuse to spend our management fees on infrastructure. We're being way too tight, but we have to because, we want to keep things lean. We want to keep costs low. And it's fun to be hands-on,
Yeah. Yeah. I think you're overly charitable, personally. I would be happy paying a slightly higher management fee so you could have an assistant to free up your time and better leverage your expertise.
I know, but
not through the roof, but I mean, you can pay somebody $100,000 a year to help you sort through the nonsense.
It's like when I was running my company, I was a control freak. I had a really hard time delegating, and I had to quickly learn to adapt. We had hundreds of employees, and in the end, I outsourced everything. If something came to me, I'd get that monkey off my shoulder. Give it to someone else. Yeah. Say no. Nothing should be coming to me as a CEO anymore unless it's like our top three. And even then, I need to have a team, right? As a CEO of a larger company, you need to outsource.
Yeah.
And I thought, I've lost my ways as a founder. And here I am running a VC firm and I'm hands-on. Don't even want to hire a VA or a receptionist or, an admin or whatever because don't know. I feel like you've got to get into the deal yourself. You've got to look at the company. You've got to do those reference calls. Those aren't things I think you can easily outsource. Those are things that are, look, when you're in this business like real estate or venture capital, it's very much about the person. It's very much about your expertise. That's a challenge to scale, for sure.
Yeah. Well put, Zain. I want to be respectful of your time, but again, thank you for joining me. This was really enlightening to me. It was great to meet you and great to chat.
Likewise, enjoyed it. Thank you for having me on the show.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.